very interesting market, but with big tech stocks coming under pressure around earnings, it's one that's turning a little bit negative. Obviously, we've had a really good run. A lot of these stocks were expensive coming into these numbers, and a lot of the numbers are downright impressive. In fact, most of them. That's kind of the reason why stocks look particularly weak and why the green light, I think, has got to go yellow for technical reasons, but also some fundamental ones, and the fact that bonds have been selling off through all of it. Might just be a temporary adjustment to the characterization of the trend, but I think we do have to characterize the trend as yellow. Firstly, come back to the rising wedge we've been watching in the options flow segment with Kevin Green. We broke out of that, and this was a really flexible way to still describe the market in an uptrend. So we were losing momentum, which is kind of the nature of the wedge. You're losing momentum on the way up. I've actually pointed out these patterns in the past, and Mr. Rick Ducat was the one who first taught me about the ascending wedge or the rising wedge, because when they break to the downside, they can get kind of ugly, because what was happening on the way up was a slowing of momentum. Some of crypto's biggest sell-offs have happened through ascending wedges. So the fact that we broke that down, I think you have to at least have the yellow light to respect the technical break of the uptrend. Now, if stocks get back to highs, if the NASDAQ gets back to a high, green light goes back on. Pretty simple. That would define the resumption of the uptrend. Also, because the NASDAQ fell right short of the previous high, it seems like a lot of these stocks look like they could get range bound for some time, namely the way Microsoft gapped down despite some pretty good numbers there. Apple's having trouble getting going despite hitting across the board, basically where analysts expected. So clearly the bar is just a little bit too high, and that's telling us the valuations maybe got a little bit too high. And that's what the bond market's telling us too, to some extent. The fact that we've continued to have bonds selling and dollar support tells us right now that the market is having some risk build thematically in a very problematic way, and that's that the 60-40 is kind of under threat. When you get stocks selling off for stock reasons and then bonds selling off throughout of it, where treasuries don't catch a bid, it's not a good look. The dollar continues to generally find support on the chart at around 103.7. That's where we kept bouncing. So the dollar might have some resistance also ahead, but the fact that it has been stable and yields have been creeping higher tells me that the market's revisiting some of the Fed expectations as well. Could be very interesting if next week the Fed decides to actually hold, and they very well may. I'm not sure why the market's not assigning more probability of that. If tomorrow's employment goes really well and yields keep going up, and they've been going up since the Fed cut 50, the only reasonable conclusion would be if they cut again, yields are going to just go vertical. Does the Fed really want that to happen? I've never been a believer that the Fed's like in a box or anything, and actually I think yields going up have been for very good reason. The economy continues to surprise positively, which generally it has. But when you see inflation come in a little bit warm this morning, suddenly the possibility the bonds and stocks could sell off again together deserves our attention. The other thing is that the VIX is starting to pick up. A lot of people say you can't do technical analysis on the VIX because you've got the zero bound at the downside, whatever. You've got what looks to be some higher high potential. My baseline framework has been that the VIX should fade around the election, but before then, nerves could keep getting amped back up, especially also as the prediction market range has narrowed again, which you may recall last week I talked about the arbitrage trade, basically, that it was probably more like a 55-45 Trump-Kamala spread based on just an equal weight between polls and the prediction markets, and that's now where the prediction markets have come to. So if the race is going to be narrow, Mike Townsend told us still basically a tie right now, then there's no reason for volatility to subside until that event is through. Earnings leading to sell-offs is not helping, obviously. Bonds selling off, not helping either. Have a great night. Thanks for tuning into The Long Show. I'll see you in the morning.